The next stock I'm going to introduce is Eli Lilly. Over the past few weeks, there has been some good news surrounding the anti-obesity drug class, and in particular Eli Lilly's Zepbound. Most importantly, Zepbound is approved in the United States and approved by the EMA for obesity. In the United States, Zepbound has a list price of $1,060 per month, which is a 20% discount compared to Novo Nordisk's Wegovy. Lilly also has a savings program for commercial insurers, as well as uninsured Zepbound. Second, over the weekend, data from the SELECT study were presented at the American Heart Association meeting. Of note, top-line data from this study were published in August and showed that 2.4 mg semaglutide once weekly was associated with a 20% reduction in major cardiovascular events in a group with heart disease, obesity or overweight. No history of diabetes. The updated data, from a placebo-controlled trial of 17,600 patients, showed that the beneficial effects are consistent in direction across all defined patients. The risk reduction of the complications of heart failure was 18% and of death from all causes was 19%. There was also a 22% reduction in the risk of progression of chronic kidney disease and renal death, and a 28% reduction in the risk of non-fatal myocardial infarction compared to placebo. A high proportion of patients with diabetes on semaglutide achieved normoglycemia. As expected, the higher discontinuation rate in the semaglutide group was due to gastrointestinal events. Importantly, given that weight loss was 9.4% with semaglutide and 0.9% with placebo, the fact that the benefits began to be divided early may indicate other benefits of the drug, including the reduction of inflammation, ventricular function left-hand better, and plaque stability. I found that it has been suggested that GLP-1 may be effective in some CNS disorders. Dr. Anya Jastreboff of the Yale School of Medicine estimated that 6.6 million Americans met the criteria for the SELECT test in 2018, up from 4.3 million in 2012. I have already reviewed my forecast for the anti-obesity drug class, which suggests $150 billion in U.S. revenue by 2030, exceeding consensus estimates. In the next 18 months, injectables from Novo and Lilly will be the treatment option. In the second half of 2025 or the beginning of 2026, it is expected that oral drugs for both companies will be approved. Although the oral formula makes it less weighty, this market will not be scrutinized in the same way as the statin market, where the lower is better principle has allowed Lipitor and Crestor to gain market share. For about 20% of patients, the pill will be chosen as an injection, and there will be 15% of obese patients. Some people may want to switch to oral medications as maintenance therapy once the initial weight gain is achieved with injectable medications. Therefore, it will be the responsibility of the doctor to discuss treatment options and side effects with each patient. As more outcome data become available over the next 3 years, insurers, including Medicare, will offer coverage for eligible patients. As I said in my last article on Lilly, a study from the health company Accolade suggested that 43% of employers plan to cover prescription drugs in 2024, from 25% in 2023. 99% of employers now cover GLP-1. Because obesity is expected to continue to do so. Additionally, the 6.6 million Americans who meet the SELECT criteria would fit into a U.S. market that could account for more than $50 billion at $8,000 per patient per year, and $33 billion at a long-term cost estimate of $5,000. During the 2024 to 2027 period, several GLP-1 class trials will be conducted and are expected to show positive results in various chronic conditions and diseases, including NASH and sleep apnea. I expect Lilly to earn EPS above $50 in 2030 compared to the consensus estimate of $40. I also expect 2024 EPS to exceed the consensus estimate of $12.35. The next stock I'm going to introduce is Zscaler. A year later, tech products are no longer cheap. Zscaler, like many of its technology sector peers, has responded to the tough economic environment by boosting revenue growth and increasing its operating margin. ZS has benefited from a rare security flight among its customers who have expressed interest in vendors with comprehensive platform offerings. Although the stock has returned to a healthy price, I think that Wall Street can reward technology companies like ZS with higher prices in the future due to their strong performance in the current environment. I expect the cybersecurity industry to continue to drive the market growth rate for this industry. I reiterate my buy rating for long-term focused investors. It may be hard to believe, but it was as recently as May of this year that Wall Street had serious doubts about ZS stock, at one time sending it to $80 low. The business has bounced back from its lows as the company's financial results have proven skeptics to be negative. In the most recent quarter, ZS reported a revenue increase of 43% from the year to $455 million, exceeding the forecast of $431 million. Hopefully it goes without saying that planting and growing a policy in this tough economic environment is no easy task. While smaller operators have seen their customer base grow rapidly, ZS continues to expand its customer base, especially among larger customers. ZS combines strong revenue growth with 38% growth in billings. The increase in debt can often indicate future income growth, so the high number has increased the concern of investors who are thinking about a serious decrease in the future. ZS closed the year with a non-GAAP operating margin of 15% and a net profit margin of 21%. The company continues to work towards its long-term goal of a 20% profit margin. ZS ended the quarter with $2.1 billion in cash and $1.1 billion in exchange-traded funds. With its positive cash flow generation, this represents a strong balance sheet. Looking ahead, management expects revenue growth of 33% on an annual basis in the next quarter and 28% on a full-year basis for the full year. Management also expects operating margins to increase by 100 basis points. During the conference call, management said that its guidance includes a large environment as in the previous year. Management says the results are strong in its view that good cybersecurity isn't good enough. Ironically, this challenging economic environment has proven to provide a competitive harbor for a strong platform company like ZS. As customers have shown great interest in the brand Famous People, management described its position in the artificial AI world as including its ability to allow customers to control how employees use AI, helping to protect against the disclosure of sensitive information and employee motivation. ZS stock sold off briefly in the quarter following news of Microsoft's entry into the space. Management appears unfazed by the perceived threat, insisting it has a strong position in the company's major industries, and said low-performing employees could be affected. Again, the tough economic environment, with rising interest rates and fears of a recession, has affected the global driver through tight IT budgets and resistance to starting new projects. ZS has opposed this practice, mainly because it is a competent and well-known operator with a large product portfolio. What are the main risks? The most obvious risk is that the reverse compatibility strategy may be too strong. Cybersecurity is certainly one of the most dynamic technology sectors, with a much slower growth rate than its peers. It may only be a matter of time before gravity takes hold of the cybersecurity title. It may also be that the macroeconomic situation is worsening to the point where income growth is under pressure. ZS sells at a price that causes future growth, because the product does not sell at a high capacity immediately through many expansions. If the impact will worsen, as it is during the technical stock crash of 2022, then ZS may have some changes. From a financial point of view, I'm not too worried about profit and loss, but investors with weak years should be careful. Although MSFT does not appear to be a threat, at least in the short term, it still remains the elephant in the room and the expected competition may eventually destroy the price. I reiterate my buy rating for the stock, even though the ongoing rally has removed any clear potential for more expansion. I consider ZS to be one of the best growth stories on the market and worth paying for.